Now that you figured out how much you need for a down payment, the question is, where can that money actually come from? That's what we're breaking down today on Money Minutes with Seb, the accepted source of down payments in Canada, whether you're buying your first home, a second property, or an investment unit. Let's start with the traditional sources lenders like to see. First, personal savings. This is the most common and straightforward source. It's basically money saved in your checking account, savings account, or even in your TFSA, tax-free savings account. In all cases, you must be able to show you've had the funds for at least 90 days. Lenders will require account statements to prove that. Second are the RRSPs, or Registered Retirement Savings Plan. If you're a first-time home buyer, you may qualify for what's called the Home Buyer's Plan. This basically allows you to withdraw up to $60,000 from your RRSP, and this tax-free. And if you're buying with a partner who also qualifies, that's up to $120,000 combined. You do, however, have to repay it over the next 15 years. But what a great tool for first-time home buyers. Third, gifted down payments, a non-repayable gift from an immediate family member, like a parent or a grandparent. The key here is that it must truly be a gift, and it'll need to be supported by a signed gift letter confirming no repayment is expected. Fourth is the sale of an existing property. If you're upgrading or downsizing, the equity from the sale of the current home can be used towards the next down payment. But lenders will want to see the agreement of purchase and sale, and also a copy of the net proceeds once the sale closes. Fifth, inheritance or settlement funds. An inheritance, life insurance payout, or even legal settlements can also be considered, as long as you have the documents to back up the source of funds, and you can also show the funds are in your possession. Now, let's talk about not so traditional sources of down payment that some lenders are starting to accept. Number one is cryptocurrency. Yep, cryptocurrency. Some lenders, particularly alternative or private ones, they're now open to crypto being part of a down payment. But, and this is a big but, they'll usually require proof of original purchase of the crypto, proof of liquidation of the crypto into Canadian dollars, and finally, the funds will have to have been held in a Canadian account for at least 90 days. So if you're planning to use cryptocurrency to buy real estate, do it well in advance and keep all your records. 2, borrowed funds. Sometimes. In certain cases, lenders may accept borrowed funds like personal loans or lines of credit, but only if you qualify to carry both the mortgage and the debt. This often reduces your borrowing power, and not all lenders allow it, especially not for insured mortgages. Number 3, business income or dividend draws. If you're self-employed, some lenders may also allow you to use funds from your corporation, as long as it's documented, traceable, and declared income. Talk to your mortgage broker. Yeah, that's me. To make sure the source won't raise red flags. Let's quickly talk about what's not allowed. Well, cash deposits with no paper trail? Not allowed. Loans disguised as a gift? Not allowed. Recently acquired assets with no history? Again, not allowed. All these raise flags for lenders and insurers alike. So my final thoughts, when it comes down to down payments, the source of the money matters just as much as the amount. Every lender has their own policies, but one thing's for sure, are the funds need to be legit, stable, and under your control. If you're planning a purchase and want to be sure about your down payment source, well, reach out. I'll guide you through it. And of course, don't forget to subscribe and click the bell so you never miss a tip. That was your Money Minutes with Seb. See you next time.